The Federal Reserve System, or Fed, is the central bank of the United States and is an important part of our nation's financial system. The Fed has four basic responsibilities: regulating commercial banks, performing banking-related activities for the U.S. Treasury, providing services for member banks, and setting monetary policy. Let's look a little at how the Fed is organized. The United States is divided into 12 Federal Reserve districts, each with its own Federal Reserve Bank. Each district bank supplies banks within its district with currency and facilitates the clearing of checks. District banks are run by a 9-member board of directors. The governing body of the Federal Reserve System is the Board of Governors. The board consists of 7 members appointed by the President and confirmed by the Senate. The Fed is designed to be politically independent. Fed governors are appointed to 14-year terms, staggered so that a president could not appoint a majority during a single term. The Federal Open Markets Committee, the FOMC, sets most policies regarding monetary policy and interest rates. The FOMC is made up of the 7 board members and 5 representatives of the district banks, who serve on a rotating basis. The Fed's most important function is setting monetary policy. The Federal Reserve System uses monetary policy to manage the growth rate in the supply of money and credit, usually through the use of interest rates. The Fed's job is to ensure that the money supply grows at an appropriate rate, allowing the economy to expand and inflation to remain in check. If the money supply grows too slowly, economic growth will slow, unemployment will increase, and the risk of recession will also increase. If the money supply grows too rapidly, inflationary pressures will build. The Fed has several policy tools it can use to impact the money supply. On this slide, we will look at 3 of them. The Fed requires banks to hold reserves, defined as cash in their vaults plus deposits at district Federal Reserve banks, equal to a certain percentage of what the bank holds in deposits. For instance, if the reserve requirement is 5% and someone deposits $100, then $5 has to be held in reserves. Only 95% of that deposit can be lent or invested. By changing the reserve requirement, the Fed can affect the amount of money available for loans. The higher the requirement, the less money available for loans. Because any change in the reserve requirement can have a sudden and dramatic impact on the money supply, the Fed rarely uses this tool. Another policy tool is the discount rate, the interest rate at which the Federal Reserve banks make short-term loans to member banks. A bank might need a short-term loan if transactions leave it short of reserves. If the Fed wants to slow the growth rate in the money supply, it increases the discount rate. This increase makes it more expensive for banks to borrow money. Banks in turn raise the interest rates they charge on loans to consumers and businesses. The end result is a slowdown in economic activity. Lowering the discount rate has the opposite effect. The third policy tool, and the one used most often, is open market operations, the technique of controlling the money supply growth rate by buying or selling U.S. Treasury securities. If the Fed buys Treasury securities, the money it pays enters circulation, increasing the money supply and lowering interest rates. When the Fed sells Treasury securities, money is taken out of circulation and interest rates rise. By using the tools at its disposal, the Federal Reserve strives to seek a balance in the growth of the money supply so that it doesn't grow too quickly, leading to inflation, or grow too slowly and lead us into recession.